Okay, I want you to picture this. You wake up on a perfectly ordinary Monday morning. You pour your coffee, you check your phone, head out the door to start your week. Everything feels completely normal. You stop by the local ATM to pull out a little cash for groceries or maybe lunch. You punch in your PIN, request a standard amount, but the machine just beeps. Transaction denied. Okay. You assume it's just a glitch, right? So you walk 2 blocks over to another bank. Denied again. Now you're getting a little worried. You open your banking app on your phone. Your balance is right there, your life savings glowing in digital green. But you literally can't touch a single cent of it. You aren't broke, your account hasn't been hacked, but you suddenly have absolutely zero purchasing power. Because while you were sleeping, your entire country literally ran out of physical cash. Now, this isn't some dystopian movie plot. It's a real-life, modern-day financial thriller. Welcome to This Explainer. Today, we're diving deep into a crazy story of international finance, political brinkmanship, and real human desperation: the 2015 Greek debt crisis.
Take a look at this number right here, 60 euros. That's roughly 65 US dollars. Try to genuinely imagine the sheer stomach-dropping panic of waking up and discovering that this is the absolute maximum amount of your own money you are legally allowed to access in a single day. Think about that. You can't pay your rent in cash, you can't just buy a plane ticket and bail out of the country. And no, if you miss a day, it doesn't roll over, you don't get 120 euros the next day. That allowance is just gone forever. This sudden, massive loss of liquidity was the suffocating reality for millions of Greek citizens during the summer of 2015. Literally overnight, the lifeblood of the economy was choked off. Businesses couldn't pay their suppliers, imports completely froze, and regular people were left standing out in the sweltering Mediterranean heat, staring blankly at ATMs that had been entirely drained of cash. It was a total, absolute collapse of financial mobility.
So let's jump right into Section 1, the Bailout Debt Trap.
So how exactly does a modern European economy just hit a brick wall and get forced to put a hard stop on its own banking system? Well, they were cornered in this massive multi-year macroeconomic trap. Look at these numbers. We're talking about 3 successive international bailouts totaling an astronomical 290 billion euros. But here's the catch. These bailouts came with some seriously severe strings attached. We're talking relentless austerity, punishing tax hikes, and deep, deep income cuts. And the result of all that leverage? The Greek economy literally shrank by a quarter. 25% of the entire economy's value just evaporated. To put that into perspective, that is a contraction rivaling the Great Depression in the United States. And check out that unemployment rate, hovering near 20%. That was the highest in the European Union by a massive margin. The country was completely trapped. They desperately needed the bailout capital just to service their debt, but the conditions attached to that money were actively suffocating the economy's ability to ever recover or generate any organic growth. And this perfectly sets the stage for a terrifying financial mechanism: capital controls. Put simply, this is the ultimate emergency brake. It's pulled by a government to stop its banking system from bleeding to death. Because, when people lose faith in their banks, they panic. They all rush to pull their money out at the exact same time. But as we know, banks don't actually keep everyone's money sitting in a vault. They lend it out, they invest it, they create leverage. If everyone demands their cash on the exact same Tuesday, the bank collapses. So capital controls freeze the entire system to prevent a total catastrophic bank run. It's a move of absolute desperation, signaling that the structural integrity of the financial system has just completely failed. And that desperation was the result of a colossal political clash. In one corner, you had the European creditors, the European Commission, the European Central Bank, and the International Monetary Fund. They held the massive purse strings, and they were demanding strict economic reforms, harsh income cuts, and tax hikes before they handed over any more cash. In the other corner, you had the newly elected Greek leadership, led by Prime Minister Alexis Tsipras and his fiery finance minister Yanis Varoufakis. They ran on a mandate to restore Greek dignity and completely refuse any more austerity. It was basically a high-stakes game of financial chicken playing out on the global stage. Both sides firmly believed the other would eventually swerve. But spoiler alert, neither did.
All right, moving on to Section 2, a weekend of panic.
So the deadline for Greece to make a massive debt repayment is looming, and the entire European banking system is holding its collective breath. Walk with me through this rapid-fire timeline, because it shows exactly how fast a modern financial machine can break down. On Friday, June 26th, fear just peaks. Greek citizens sense the impending doom, and they pull their money out so fast that bank deposits hit an 11-year low. The banks are bleeding dry. Then, the bombshell. On Saturday, Prime Minister Tsipras abruptly announces a national referendum. He's actually going to let the Greek people vote on whether to accept the creditors' terms. The European authorities are completely stunned. By Sunday, the system just breaks. With no bailout extension in sight, the Greek government is forced to announce capital controls and a bank holiday. And then on Tuesday, June 30th, the unthinkable happens. Greece officially misses a massive €1.5 billion loan payment to the IMF. They become the first developed country in history to fall into arrears with the fund.
This right here clearly illustrates the domino effect of a full-blown banking collapse. Step 1, the depositors panic and rush the ATMs to secure physical cash. Step 2, the European Central Bank, seeing this immense systemic risk, caps what is known as Emergency Liquidity Assistance, or ELA. Now, ELA is basically the financial life support machine for struggling banks. Once the ECB caps that life support, the Greek banks are effectively dead in the water. They literally do not have the physical paper money in the vaults to hand out to their clients, which forces Step 3. The Greek government steps in, shuts the bank doors entirely, and limits the ATMs just to stop the total collapse. The music had officially stopped, and there were absolutely no chairs left.
Greek banks will not open on Monday. I mean, just read that again. Imagine hearing that on the evening news in a modern, developed nation. This single devastating sentence sent an absolute shockwave through the Athens stock market, which, by the way, also remained firmly shut, and it crashed violently into the lives of ordinary citizens. The highly abstract world of bond yields, institutional leverage, and macroeconomic policy had suddenly become an incredibly terrifying, visceral reality for millions of people who were just trying to feed their families.
Which brings us to Section 3, the human cost.
Because behind all the billions of euros, the bond yields, and those high-level summits in Brussels, there was a brutal, very real human cost on the streets of Athens. While younger people with debit cards were limited to that €60 a day, a massive segment of the population was entirely locked out, the elderly. Hundreds of thousands of Greek pensioners didn't even use debit cards. They used old-school deposit books inside the physical bank branches. With the banks shut, they had zero access to their life savings. So to prevent a total humanitarian disaster, the government briefly opened about 1,000 bank branches nationwide, just for them. But the limit was staggering. They were allowed to withdraw a maximum of €120 to survive the entire week.
Just listen to the words of Vasilis Argytis. He's a 69-year-old pensioner who queued at dawn outside a bank in central Athens. He said, "It's not too soon. I was starting to get extremely concerned. Now at least I have these €120 for 1 week." Now here is the kicker. He was a man who had actually worked for 35 years at American Express. He deeply understood finance, he understood liquidity, and yet, here he was, standing in the sweltering heat, terrified that his life savings had simply vanished into thin air, just praying that €120 would be enough to buy groceries and medicine for the week. The irony is just chilling. This intense period produced some of the most heartbreaking images in modern European history. You had scenes of men like Georgios Chatsifodiadis, an elderly pensioner, who literally collapsed and wept on the bare ground outside a bank. Why? Because he had failed 4 consecutive times to withdraw cash on behalf of his wife. As the source material grimly points out, these are the victims of the economic crisis in Greece, only a few failed ATM withdrawals away from absolute poverty. These were proud, hardworking people, suddenly reduced to begging institutions just to access their own money.
But the invisible damage actually went far deeper than just frozen ATMs. Take a look at Vasilis Argytis' monthly pension. Before the crisis hit, he was receiving €1,800 a month. By the summer of 2015, relentless austerity measures had actively slashed it down to €1,300. Guys, that is a permanent €500 a month pay cut to an investor and retiree relying on a fixed income. For anyone planning their retirement or managing a fixed income portfolio, this is literally the nightmare scenario. The crisis didn't just temporarily freeze their bank accounts, it permanently decimated their future livelihoods. The financial foundation beneath their feet had simply crumbled.
Okay, let's dive into Section 4, the referendum shockwave. While the people suffered in the streets, the political drama behind the scenes reached an absolute fever pitch. The country was hurtling toward the July 5th referendum. It was going to be a historic, chaotic vote where the Greek public would essentially decide their own fate. The entire global financial community was watching. The markets were totally on edge. The actual question on the ballot was incredibly complex, referring to all these specific European Commission documents. But the core of it was simple. Would the Greek people surrender? Would they accept the European creditors' punishing demands for more austerity, more pension cuts, and more tax hikes? Or would they say no and risk being thrown out of the Eurozone entirely, returning to their old currency, the drachma, and facing total economic isolation. And the result? It sent shockwaves around the world. Over 61% of Greeks voted a resounding no, or oxy in Greek. They actually defied the massive international lenders. They rejected the austerity. There were huge, wild celebrations in the streets of Athens. But that euphoria was incredibly short-lived and totally chaotic, because the very next day, Finance Minister Yanis Varoufakis, the main architect of this defiant strategy, just abruptly resigns. And despite the massive defiant vote from the people, the harsh, unforgiving reality of the economics hadn't changed one bit. The Greek banks were still completely out of cash, and their doors remained firmly closed. And here is where we find the ultimate, bitter irony of this entire financial thriller. You really have to understand the brutal reality of leverage in business and finance here. The Greek people overwhelmingly voted no, but the Greek government had entirely run out of money. So within just days of that defiant referendum, Prime Minister Tsipras was basically forced to return to the negotiating table and surrender. He signed a brand new €53.5 billion bailout package that actually included even worse and harsher terms than the ones the Greek people had just overwhelmingly rejected. Why? Because when you are totally out of liquidity, you are totally out of leverage. They had to sign it just to survive.
Finally, let's look at Section 5, the long aftermath. You see, the signing of that third bailout wasn't the end of the story. It was just the beginning of an agonizingly slow recovery. The acute panic ended, sure, but the chronic pain had just begun. Just trace this timeline to see exactly how deep the trauma went. The third bailout was approved in August 2015, but it took 3 grueling years of strict financial dieting before Greece formally emerged from the bailout program in August 2018. And honestly, the most shocking part? Those capital controls, the strict limits on taking your own cash out of the ATM, they haunted the country for over 3 years. It wasn't until October 2018, over 39 months after that fateful weekend of panic, that the finance ministry finally lifted the restrictions on domestic cash withdrawals. For over 3 years, an entire developed nation lived with a daily allowance on their own money.
And even after the bailouts officially ended, the deep economic scars and market distrust were baked right into the numbers. Just look at the 10-year bond rates in the fall of 2018. This is essentially how much it costs government to borrow money from the open market. Greece was still paying just above 4% interest. Meanwhile, an economic powerhouse like Germany was paying only 0.5%. The global financial markets were essentially saying, hey, we see that you survived, but we still don't fully trust you. The penalty for the crisis was a massive, lingering premium on their national debt. And a premium like that hurts a country long-term, because those are hundreds of millions of euros diverted away from building infrastructure and public services and sent straight to creditors just to service the interest on the debt. It's a massive, heavy financial anchor.
Ultimately, the Greek debt crisis is an absolute masterclass in the fragility of modern finance. It really shows us that liquidity is, in many ways, just a shared illusion, built entirely on trust and leverage. And when that trust evaporates, the digital numbers glowing in our accounts mean absolutely nothing. We watched a modern, developed European economy luck millions of its own citizens out of their life savings literally overnight. The ATMs ran dry, proud pensioners wept in the streets, and an entire nation was brought to its knees by the cold, hard arithmetic of the bond market. Which leaves us with a chilling, thought-provoking question to end on today. If it could happen there, so quickly, and with such devastating precision, how safe is the money sitting in your digital bank account right now? Thank you for checking out this explainer. Until next time, stay curious and keep learning.